I would be doing you a disservice if I did not bring up the pros and cons of these private credit ETFs that are coming out now. Hey everyone, I'm Andrew. I'm a CFA charter holder and a CFP professional who has spent the last several years helping ultra high net worth and high net worth investors with their complex financial lives. I'm also the owner of Lever Wealth Management, which is the financial advisor for people who scare financial advisors. And what I do is I take the stories and learnings from the thousands of iterations I've had over the years, and I give them to you so that you can apply them to your own situation. Today, I want to talk about these new private credit ETFs and what they're all about, what that means for investing, and also the good and the bad. So first, let's define our terms. What is private credit? Private credit are either loans or debt that's been raised that is not traded on the public markets. So Johnson & Johnson, Coca-Cola, Cisco, they all raise debt through the public markets and you can buy their bonds, right? They can also have loans and lines of credit through banks. Private credit was a pretty small subset of the investment space, mostly actually to insurance companies because of their long time horizon and ability to take liquidity risk. After the Dodd-Frank Act was passed in light of the financial crisis in 2008, banks were only allowed to have so much leverage on their balance sheet, and so they stopped making certain loans that had wider covenants, that had lower debt to EBITDA margins, receivable requirements, those types of things. And so when banks stopped doing that lending, these private companies started doing that lending. And that's not inherently wrong. It was just there was a need in the market and they started to fill it. Well, I have generally been a fan of private credit, but you cannot simultaneously have an illiquid investment and a completely liquid investment vehicle. Meaning this, State Street just released this new Apollo Private Credit ETF. I don't know the actual name, but I was reading it. I believe it was an article on Bloomberg. And SEC mandates only so much of the investments within an ETF can actually be illiquid in nature because it's a liquid product that's priced intraday, meaning throughout the day, just like the S&P 500. The problem with that is if the majority of the bonds and loans in the vehicle cannot be private, you can't get those private market returns. So what Apollo said was, don't worry, we'll be the market maker. If nobody else is willing to give a bid to buy the security, we will. Think of it like this. You have an extra 100,000 and you want to invest in a house flipping business. And so you see somebody else who's flipping houses continually, and they've shown they can generate amazing returns, 10, 15% a year of returns. And so you say, hey, I would like to seed and be a limited partner in your house flipping business. And they go, well, that's great because I've been having to use only my own capital. Now I can engage in more house flipping, right? And so you look at their returns, and again, the returns are great. You say, well, how do you know what the houses are worth? And they say, well, the great thing about my house flipping business is if you ever need your 100,000 back, you can just take it out tomorrow. And you go, well, isn't the money tied up in the houses for a period of time while you're doing the renovation and getting it ready to be sold and then sold? They say, yeah, but don't worry. We have an appraiser. It's all good. But it turns out the house flipper is also the appraiser. They're one and the same. And so whenever the market is going up and things are well, the house flipper, who most likely has excess cash on hand, is saying the value of my properties is very high. And if people need their money back, no problem. I'll just give them the money back because I've been making money on all these other flips. The problem is when the inverse is true. If you give people liquidity, but the exact business you are in is illiquid. If the market goes down and now they're selling the houses for 70 cents on the dollar, either their cash pile needs to be really, really high. They need to have amazing funding from new limited partners or banks. And the problem is banks seldom give you money when you want and tend to give you money when you don't want it. So now they're selling the houses for 70 cents on the dollar, but they told you can take your 100,000 back whenever you want. You could see how this would be a real issue. And in the real world, where it would become an issue is the underlying assets may have a different intrinsic value than the NAV, the net asset value. Said more simply, what the ETF trades at may become distance from the true value of the assets. And that's assuming the assets are worth what you think they are. If you can't tell by this point, I'm very against this idea. Private markets have their place in certain portfolios, but you cannot get the return over a long period of time in markets without the risk. It just doesn't work like that. There are trade-offs in investing, and you cannot create ETFs to provide daily liquidity with an investment that has lockups typically anywhere from a year to 3 to 4 years. Some of these limited partnerships even last up to 5 years in private credit. And I haven't even gotten into sub-managers, how many turns of leverage. I think these are really dangerous vehicles to put into the hands of people who may not fully understand them. So that's my 2 cents. It's just one man's opinion, but I think they, in the wrong hands, could be very, very dangerous to put into a portfolio. So hopefully that's helpful for you and sheds a little light on the private credit market in general. And until next time, thanks everyone. Talk to you soon.